We're taking a break from the lately regularly scheduled programming of AI bubble discussion, depreciation, frauds,
Michael Burry.
Michael Burry. We're skipping all that today to talk about cybersecurity.
If you've been with us for a while, you know that we're not just all about semiconductor stocks, but also all about top secular growth trend end markets for semiconductors and cybersecurity and AI native cybersecurity, kind of one of the more recent buzzwords in that department. This is something that we've been talking about since the inception of Chip Stock Investor.
The expected annual growth for the cybersecurity industry around 12% in the next 5 to 7 years. Just in 2025 alone, $215 billion spent in cybersecurity. And the biggest portions of the industry, network security and cloud security, which is what we're going to be focusing on today with Palo Alto Networks. And Palo Alto Networks has been expanding heavily by acquisition. And the reason for this?
As cloud and AI gets more pervasive all across not just the IT sector, but IT spending becomes increasingly more pervasive through all the other non-IT sectors of the economy, companies need all sorts of tools available to them to protect their specific workloads. And of course, that spans everything from on-premises security, a physical location like an office or a factory. It could be in a data center where AI agents are running around automating work, or it could just be good old-fashioned human workers carrying electronic devices, getting stuff done, or maybe not getting stuff done at the water cooler. Either way, it needs protected. And so with this big increase in different use cases, AI itself is a big data security risk as well. These network and cloud security platforms like Palo Alto Networks are making a push into more software-based services on the right-hand side of this chart.
Here is Palo Alto Networks' quarterly revenue and growth rate. You can see kind of in the middle of the chart there in the July 2024 quarter, they had this bottoming out of revenue growth. But since then, they accelerated a little bit over a couple of quarters. And then the last two, you can see the revenue growth rate has been about 16%. And this growth rate that Palo Alto has experienced has been slightly outpacing the average industry growth levels. You're going to see a couple of other charts from our friends over at fiscal.ai. And with our link, you can get 25% off of any paid plan from Wednesday, November 26th through Monday, December 1st. This is one of only 2 sales that they run each year. So a great time to get a membership.
Besides running financial visuals like this one on fiscal.ai, is a great overall platform to help you sift through the businesses that you are interested in owning. They have a great stock screener that's actually built into the platform. So before you even get to this step where you try to understand the business and its financials, you can dig through the metrics that matter most to you to help whittle down your possible buy list.
Check out the link here in the video in the description. Get 25% off any paid plan, even that pro plan from Wednesday, November 26th through Monday, December 1st.
It's a pretty sweet deal. Here's another fiscal.ai chart. This one on Palo Alto's quarterly GAAP earnings per share and free cash flow per share. Talked about some of these metrics on the depreciation video last week. Remember, GAAP earnings per share is the profit metric that is reported basically for tax reasons. It sort of smooths out results, but even the so-called smooth out of per share profitability for Palo Alto Networks been kind of variable as of late. And then free cash flow on a per share basis, it's been really variable. But the main takeaway that you should get from this at this particular point is Palo Alto is profitable even as it undergoes this current run of M&A. Pretty hefty M&A happening, actually. And let's maybe continue and talk about this latest one that is now happening in the cloud observability market. This is a new software product type for Palo Alto's cybersecurity platform. And what is observability? If you are an investor in either Datadog or Dynatrace, you probably know all about cloud observability, kind of an extension of the data analytics market. It's one of the tools that is adjacent to cybersecurity and maybe perhaps even kind of merging with cybersecurity a bit. It's kind of a natural extension of what a cybersecurity platform and a cybersecurity security ops team needs. And so this seems like a pretty natural fit for Palo Alto Networks.
Palo Alto is buying Chronosphere, and we have that highlighted here in Gartner's Magic Quadrants. On the left side, this was as of June 2024. Chronosphere is highlighted in yellow, Datadog, Dynatrace in green. And then on the right side, this was earlier this year, Chronosphere is highlighted in pink on that side. But a lot of these companies in this specific market in observability have been taken private by private equity firms such as Sumo Logic and New Relic. Both of those were acquired by Francisco Partners. And then Splunk, that was a big acquisition made by Cisco, SolarWinds, by Turn River Capital. So we have a lot of companies here, a huge SaaS market that needs some consolidation.
And of course, the hyperscalers are on this list, ex Google Cloud, ostensibly. Google Cloud also has observability software suite, as does Wiz Security, which is pending acquisition by Google Cloud. So yeah, crowded market here. Dynatrace and Datadog, long considered the leaders of observability. Dynatrace was the pioneer of this specific type of software, but you can see that top right quadrant in Gartner's Magic Quadrant. The leaders in vision, in product vision, and ability to execute on the strategy they have. That quadrant, kind of filling up, and Palo Alto getting in on the action to consolidate and getting its hands on one of the hot startups in this part of the market. Now let's zoom out a bit and see some of the other acquisitions that have been recently announced.
Palo Alto Networks has definitely been an acquisition-heavy company over the years, but just since September of 2024, these are the acquisitions or pending acquisitions for Palo Alto. We're not going to go over all of the details and minutiae here, but if you want that, make sure you join us over on Semiconductor Insider. We have a new research platform at our website, chipstockinvestor.com.
And the big pending one, of course, being CyberArk, which has been part of the Chipstock Investor tech universe for the last couple of years. We have another chart here from fiscal.ai, just a couple of balance sheet highlights from Palo Alto. As we talked about earlier this year, we expected that their debt would be fully paid off, and that is indeed what has happened. So a sizable little jump in cash and investments on balance this last quarter pushes them over 10 billion. Of that, 4.2 billion in cash and equivalents. And so the cash component of the CyberArk deal is going to cost them about $2 billion. Chronosphere, another just shy of 3.5 billion. Let's call it 5.5 billion. They'll generate some more free cash flow in the next couple of quarters while those deals are being worked out. But that should still leave them with at least 5 to 6 billion in other longer term investments and some other cash that's been generated via free cash flow over the next few quarters.
And since they have all of this cash to spend, we really like the cash component that they're paying for Chronosphere especially. Palo Alto is also having to pay up for all of that top talent. Stock-based compensation is starting to creep up a little bit higher again, and we'll have to account for that in the free cash flow per share calculation. But this alone probably justifies the recent sell-off for Palo Alto.
Yeah, you can see the increase there just from the previous quarter, trailing 12-month stock-based comp, 1.37 billion, up from just shy of 1.3 billion in the last trailing 12-month period. As a percentage of revenue, it's still elevated, but as Casey said, Palo Alto has been a pretty acquisition-heavy company, and in this new AI era, or whatever you want to call it, they are having to ramp up their M&A again. As a percentage of the current market cap, nearly $120 billion market cap. The stock-based comp isn't so high, but of course, that percentage is dependent on the stock price staying elevated as well, which of course, in the last couple of weeks, it hasn't stayed elevated. It has come back down, which has pushed Palo Alto's price to free cash flow on a trailing 12-month basis back closer to about 30 to 33x. Is it cheap? Well, in the last year, I suppose you could say it's cheap, but if you zoom out a couple of years, obviously excluding the depths of the bear market when all sorts of stuff was really, really dirt cheap, you could say maybe this is maybe closer to just fair value. A lot of this valuation could in the long term end up being a fantastic entry point if you're looking to up your cybersecurity investments, especially if Palo Alto is able to execute well on that big CyberArk purchase. That is going to be a big one, and we'll have some more details and our full research and full write-up over on shipstockinvestor.com on the research platform.
Now, if you've been busy living your life and you don't know what I was talking about at the beginning about the AI bubble and NVIDIA, make sure you watch this video right here. It's generating some excellent YouTube comments.
It sure is.
See you all again soon at Shipstock Investor.